Do you know the difference between an FHA loan and a conventional loan? Most people don't, and quite honestly, why should you unless you went through the home buying process? So watch this video, and I'm going to try to make it very easy for you. Hi guys, thanks for clicking on my video. My name is Chris Hooten. I've been a mortgage loan officer for over 20 years. Through that time, I've done countless number of transactions, and I wanted to tell you the difference between the two most common loan programs out there, FHA and conventional. There's some slight differences, and sometimes knowing the difference can help you make the decision on which program to go. So, FHA loan, that is primarily for first-time home buyers. And I say primarily because it normally is for people that maybe have less than perfect credit or just starting out their credit. Their debt ratios might be a little bit higher, and they have smaller down payment. Okay, so FHA, Federal Housing Association, is considered a government loan. Okay, it is overseen by HUD, but it's considered a government loan. So the benefits of FHA, like I mentioned, it does allow for lower credit scores, sometimes all the way down to 580. So obviously that's, you can have less than perfect credit and still be eligible for a home. It allows for higher debt to income ratios. So your debt to income ratio is all of your monthly debt plus the new housing payment divided by your gross monthly income. That is your debt to income ratio. So those are the benefits. And then it also allows for a smaller down payment. You only need 3.5% of the purchase price to get into a home. So on a $200,000 home, 3.5% is only $7,000. A portion or all of that can be gifted from a family member. Again, a lot of times this is first-time home buyers using this program, and maybe mom, dad, grandparents, somebody is willing to help them out with the down payment. There are also, for the FHA loan, several, and most of the first-time home buyer down payment assistance programs are for FHA loans. Okay, so you can get some assistance on top of the small down payment. You can actually have that covered, some of or all of, by one of these programs. Okay, so some of the downsides of the FHA loan primarily is the mortgage insurance factor. So mortgage insurance, for those of you that don't know, is an insurance that is applied by FHA on every single loan, and it's applied in two different ways. Number one, there's an upfront premium. Okay, they allow you to finance this, but it's 1.75% of the loan amount is added onto the loan. Okay, so again, if you do the math, if the loan amount is around $200,000, 1.75% of that is, roughly, we'll just call it $6,000. It's added onto the loan that you finance, that you pay interest on. It's obviously included in the monthly payment. So that can turn out to be a lot of money over time. In addition to that, you have a monthly mortgage insurance premium, okay? And depending on how much you put down, but assuming you put the minimum down, this is 0.85% of the loan amount. So you have a loan amount, you times it by 0.85, you divide that by 12, and that's your monthly mortgage insurance premium. So again, increases your payment, and that is money that you're paying. It's not tax deductible. It's not for your benefit. Mortgage insurance is strictly to protect from default, okay? Because the FHA loan is assuming more risk, allowing, lower credit standards and higher debt ratios, they're more likely to default. So because of that, they have everyone that has an FHA loan share in that liability through mortgage insurance, okay? So it's not to protect you. A lot of people have that misconception. It's to protect the investor, okay? So the difference between that and a conventional loan. So conventional loan has a lot of options. Number one, if you're a first-time home buyer, you can come in with as little as 3% down, okay? So actually a little bit less than the FHA loan. Traditionally, a conventional loan is for people that have a little bit stronger credit and a little bit lower debt ratio, okay? So the main benefit there is the small down payment option, and then of course you can put as much as you want down. A lot of people think on a conventional loan you have to put 20% down. That is not the case at all. I'll explain the differences in down payment in a minute. But for a first-time home buyer, you can still put as little as 3% down. So even less than FHA. Now, with conventional financing, there is no upfront mortgage insurance, so that's a big benefit. And your monthly mortgage insurance premium is determined by a couple of things. Number one, how much you put down, and number two, your credit score. Okay, whereas FHA, it doesn't matter what your credit score is, the mortgage insurance premium is exactly the same. With conventional, you are rewarded for good credit. Okay, better credit means lower risk, so that translates into a lower mortgage insurance premium. So if you have really good credit, you're definitely going to want to take the conventional route because number one, you can get in with a lower down payment. Number two, you can potentially have lower mortgage insurance and no upfront mortgage insurance, which is a huge benefit. The other thing with conventional is if you can put 20% down, there's no mortgage insurance at all. Okay, that's very different from FHA. Regardless of how much you put down, that will have, the FHA loan will have mortgage insurance for the life of the loan. Okay, many people think that eventually that mortgage insurance comes off, but with FHA it never comes off. Eventually you can refinance, pay off the FHA loan, and get rid of the mortgage insurance, but it will never come off as long as you have the FHA loan. Whereas conventional, when you get to a certain equity position, okay, you can request that the mortgage insurance be removed. Again, another difference and another benefit for going conventional financing. Conventional financing does have first-time home buyer programs, like I said, the 3% down, and then even on top of that, they have some down payment assistance programs that can help you over and above that, so you can get in for very little out of pocket. One of the other differences is their debt ratio and their credit requirements. So again, like I said, you need to have a little bit better credit for conventional financing, and your debt ratio had to be a little bit lower. So the maximum debt ratio is a little bit lower with conventional versus FHA. Obviously, there's lots and lots of little nuances, but for the most part, those are the big differences. The mortgage insurance probably being the largest difference between the two, and then also the credit flexibility that FHA offers versus conventional. So, guys, I hope this was helpful. Hope you learned a little bit. If you have any more questions, please reach out to me. I'm very easy to find. My name is Chris Hooten. I am your MLO.